connect with Mahesh Patil, co-CIO with Birla Sun Life Mutual Funds. Mahesh, good morning. Thank you for joining us. Mahesh, what do you make of the recent price trend? Suddenly Indian markets have hit some kind of a stumbling block. Mid-cap stocks are correcting and small-cap stocks are under intense pressure. News flow is strong and supportive. Why are stocks correcting then? Mahesh, is my
Well, as you rightly said, we have seen a larger correction in the mid-cap and the small caps compared to the larger cap, because year till date market is Nifty is almost flat, but mid caps and small caps are down almost like 8 to 10%. Clearly, I think we have seen the breadth of the market deteriorating. A lot of the money which came in, FI money, has actually moved up into the large cap space. Whereas on domestic we have seen redemptions, and so that has affected the small and mid cap. And again, the expectations which were there in terms of rate cuts, that has also moderated down a bit, which tends to impact the mid-cap companies much more than what we have seen. And again, in the results which have come in this quarter, while broadly I think the numbers are in line, headline numbers, but we have seen some of the mid-caps and small caps, the numbers have been disappointing, especially companies which were highly leveraged.
So what is it that you're expecting out of the budget, Mahesh? Do you think that the finance minister is going to come about with something which would provide direction to the listless market that we've been, having to deal with the last couple of trading sessions?
Yeah, I think what the market is expecting at the budget, clearly the finance minister has said that he will look at fiscal deficit, try to rein that. That's clearly something which the market will look at. But I think more importantly, it's important to see what steps are taken in the budget to really stimulate the economy, because we have seen the GDP growth coming down, growth expectations, even what we expect in the recovery, I think probably that will moderate. So clearly boost to certain key sectors like infrastructure. What are the steps to really do that, to get more funds, because our current account deficit is still running pretty high. We still need to attract capital to balance that account. So steps taken to really boost investment into the country, both domestic as well as foreign, I think that's something which we'll look at. And again, I think on the taxes, I think clearly he needs to boost the revenue side. So there would be some increase in taxes, both direct and indirect. But the magnitude of that is really going to be important, because already in a weak economy, if the taxes are increased, then that could hurt growth going down further.
So at the current juncture, Mahesh, where are you picking your spots? Where are you confident that the risk-reward ratio is favorable and now valuations are looking attractive yet again?
Well, I think clearly if you look at across, especially in the mid-cap space, we have seen a decent correction. The relative underperformance of mid-cap has come back to the level what it was in September at the beginning of the rally. So I think selectively in the mid-cap space, clearly we have seen decent valuation over there. But I think more importantly, I would say that in some of the cyclical sectors, market valuations have corrected back to decent levels. And companies where the balance sheets are good, we don't see any stress over there. I think those are companies in the cyclical space, I think when one can start looking at, because while we have seen the GDP numbers hitting a new low in December quarter, but we are hopeful that in FY14, at least we'll see some marginal uptick from those levels to around 6% or so. So that should aid some of these companies and the recovery up. And as interest rates go down, I think that should also help in terms of impairing the balance sheet. So clearly some of the select mid-cap space and even the utility space, we have seen decent correction over there. And companies where there is visibility of earnings, visibility of cash flows, and stocks which have corrected on a price to book multiple basis, I think clearly this is time to look at some of these stocks. I think clear expectations from market return and stock returns has to be much more modest. So we are happy to look at companies with 15-20% kind of an upside, with less amount of, with clear visibility in terms of earnings and valuations at comfortable levels.
Mahesh, when you say cyclicals, that obviously includes metals as well as cement. Is that the case?
Well, I'm looking at more of domestic cyclicals than the global cyclicals. So metals would be more global cyclicals. There again, we have seen actually a divergent trend domestically in terms of stock prices compared to the global metal prices, which have actually rallied. And even global metal stocks have done reasonably well. But Indian, we have seen the stocks not reacting because of other issues, domestic issues in terms of clearances, either for mines and other issues which have impacted the stock prices over here. But on the domestic cyclicals, one could start looking at autos, though it's still too early. We have seen the volume growth is disappointing. But this is a time to start accumulating some of these stocks, purely on a valuation, and hoping recovery slowly and steadily to happen in that space.
Are you buyer in oil PSUs? We've got 2 fuel price hike, 2 in less than 30 days. When we started the year, no one was factoring in oil sector reform, but thankfully for us, a big reform has kicked in.
Well, if you look at the oil and oil space, especially the downstream oil companies, they have actually corrected back to the levels when they started the rally, when the deregulation happened in the diesel prices. So I think, I think clearly we have seen that government is keen to really reduce the subsidy burden, which some of these companies are bearing. And so we would be more constructive on the upstream oil companies, companies like ONGC, Oil India, where we feel the valuation comforts is much more, and there is some possibility of gas price increase, which should benefit some of these companies. But even the downstream companies now, the post-correction, and looking at the fact that their balance sheets, the huge debt on their balance sheet, that starts to correct, as the receivables from the government in the subsidy comes down. They could also be looked at actually purely from a valuation perspective, though we don't expect any meaningful correction, benefit coming to some of these downstream companies in terms of EPS. But clearly the balance sheet, the debt on the balance sheet as the working capital comes down, that should benefit at least in reducing the interest costs. So that should improve the overall long-term value for some of the downstream oil companies.
Deutsche Bank is also making the same point that large part of the oil sector reforms, they will benefit Oil India and ONGC in the near term, because for them the total loss or the estimated loss will automatically come down. Mahesh, is there a case for financials now to underperform at least in the near term? A, the run-up has been strong. B, valuations are looking attractive. And C, Reserve Bank of India clearly is now sending conflicting signals.
Financials, again, one is it's a clear play on the underlying economy. So we have seen loan growth actually tepid, and GDP recovery, what one was expecting, as I said earlier, it's not to that extent. So in that scenario, there would be some kind of a tone down in terms of loan growth expectation. Even the retail part of the credit, which was pretty strong last year. So that's also started to slow down a bit, as we have seen the consumption taking a hit, especially if you look at two-wheeler numbers, they have slowed down. So there will be some kind of a moderation in terms of growth, for the financial services sector. But I think by and large, again, financials, you have to be, especially we have seen in the private sector space, companies have been able to still grow at above average market growth rate. And there are still spots over there, which banks or which have got a better liability franchise on the asset side is pretty comfortable. So we would be focusing on some of those names. Though the valuations, clearly I would agree, some of the private sector banks at the higher end of their long-term trends. But I think they can still continue to grow at around 20% or so, which is pretty healthy growth rate, and I don't see any reason for them to really underperform.
Okay, Mahesh, good chatting with you. Appreciate you taking the time out and joining us.